There's about 3 weeks left in this year's tax season. What are the most common tax strategies that you need to implement right now? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so there's a couple weeks left here in this tax season. Have you filed your taxes yet? Are you still underway? Have you reviewed them, but you haven't yet finalized them? One of the most powerful questions in your entire financial plan lies within tax planning, okay? And it's this question. Before you filed your taxes, you've gone and input everything and you're reviewing your return to make sure everything's accurate. You then ask this question. Is there anything that you can do right now before you file your return? Is there anything you can do right now to improve last year's tax situation? Is there anything you can do right now to improve last year's tax result so you get a better result? How the U.S. tax code is set up is there's certain things that you can do up until your tax filing deadline to help last year's tax return. You've got to ask yourself that question each and every year. And when you're doing so, really it should be your CFP asking themselves that question and then teaching and explaining that to you, bringing those ideas to you. And because we have a full team of nearly 20 certified financial planners here at KFG serving all sorts of clients, we're asking this question and presenting these ideas all of the time. What are the most common tax strategies you need to be considering that we're presenting to people right now before they file their return? The very first is, should you fund a traditional IRA? Should you fund a deductible IRA? And this is common, it's simple, yes, but it is a great question because it offers two benefits. Number one, are you in just a high tax bracket and you just need an extra tax deduction, okay? Do you think this year you're in a high tax bracket compared to what you'll be in the future? If so, the IRA gives you a deduction so you avoid some of the tax at this higher level. But then the second reason is, the IRA deduction would lower your adjusted gross income and could make you eligible for other or more tax credits. I'm talking to those of you that have students in college receiving the American Opportunity Tax Credit. This is a way to get your adjusted gross income down even lower, so maybe you qualify for more American Opportunity Tax Credit. What about if you have Affordable Care Act health insurance, healthcare.gov health insurance? Funding an IRA would reduce your adjusted gross income, could allow you to pay even less for your health insurance, i.e. getting more of these premium tax credits. What about retirement savers credit, something like that? So funding an IRA would be beneficial for last year. Doing it right now before April 18th this year is when you have to do it, to have you avoid paying tax at a high tax bracket, but also lower your adjusted gross income so that you could qualify for other tax credits. The second strategy is something we're helping a lot of people with right now, and it's really for the same reasons as the IRA, and that's funding an HSA, okay? The health savings account. You've got to have a qualifying high deductible health plan, makes you eligible to fund a health savings account, but then looking at your tax situation before you file, you've got to look and say, well, could I contribute to an HSA for last year and improve my tax situation and do so before April 18th? Sure you could, right? If you qualify. The limit for an individual is contributing $3,600 for 2021 to your HSA. If you have family coverage, it's $7,200. You can double that. If you're age 55 or older, there's an additional $1,000 that you can do. Now, those are 2021 contribution limits. They're a little bit different for 2022, but that's what you could do, and it does the same thing as the IRA that I mentioned. If you're in a higher tax bracket, this reduces your taxable income, so it means you'll pay less tax at these higher tax rates. Or if you would benefit from lowering your adjusted gross income, your AGI, if you would benefit from that so that you can qualify for more tax credits, a health savings account contribution, HSA contribution, lowers your adjusted gross income, lowers your AGI. It's known as a above the line deduction, so it would reduce your AGI and allow you to qualify for more tax credits. Work with your CFP, see if that makes sense. Third idea we're helping a lot of people with right now is fund a Roth IRA for last year. That's right, a Roth IRA. Now, the IRA that I mentioned earlier gives you a tax deduction today when it goes into that account, and then when you withdraw the money, that's when you pay tax on it out there in the future in retirement. The Roth IRA is the exact opposite. You don't get a tax benefit today, except in one unique situation. I'll explain that in a second. So when you fund that Roth IRA, it doesn't help you today, but then all the growth, compound growth over time in that account grows tax sheltered and is withdrawn tax-free in retirement. So it's the exact opposite of the IRA. But so a couple things with this. The reason why this is a question you should ask yourself, should you be funding a Roth IRA before you file your taxes this year for 2021, is because if you have extra dollars that you should be investing and deploying for your retirement for the long term, should you invest those in a way that's tax sheltered and tax free forever? Absolutely. But then the second reason is the Roth IRA could also help you qualify for other tax credits. Not many, but the Retirement Savers Tax Credit, just did a video on this just recently. It's my favorite tax credit out there. Depending on your adjusted gross income, your overall situation, funding a Roth IRA could give you a retirement savers tax credit. And where otherwise, if you didn't fund a Roth IRA or you funded an HSA, something like that, you wouldn't get this tax credit. So work with your CFP. See if right now it makes sense to fund some or all of a Roth IRA contribution for 2021. And then finally, if you own a small business or are self-employed or have some self-employed income, should you fund a SEP IRA, a Simplified Employee Pension IRA, or should you fund a profit share contribution to your single K? All right, so two different things here. If you're self-employed, you're just doing some side income, a side hustle, if you will. Likely you're not set up as an employee paying yourself a certain wage. You've just got revenue minus some expenses, and that's your profit that lands on your tax return. Off of that, you could then contribute up to 25% in most cases to a SEP IRA. This also works just like an IRA or an HSA, meaning that's an above the line tax deduction, so it helps avoid taxes at higher rates, helps reduce your adjusted gross income to qualify you for more tax credits. If you actually run a small business, though, where you're set up as an employee and you have a single K, you have set up a 401k for yourself, a solo 401k. Now, there's limits to that, but if it's just you in the business or maybe your spouse is employed too, you're allowed to set up a single K, a solo 401k. And when you do so, you can make normal contributions right out of your paycheck, or up until your tax filing deadline, you can make a profit sharing contribution. And when you do that, that is also an above the line deduction, meaning again, it saves you, helps avoid you paying tax at higher tax rates, and could qualify you for more tax credits. I hope that helps. There's still time right now for you to improve last year's tax situation before you file it, or even if you did, you'd need to amend if you hadn't already asked this question. Right now, before you file your taxes, you've got to look and say, is there anything that I could do, should do to improve last year's tax situation? How do you know, of these ideas, how do you know which ones you should implement and which ones are just good ideas, but it's something you should pass on? Look at your overall financial plan. This is why you need to be doing comprehensive financial planning with a certified financial planner, because you want to know what are all of the possible options that you have, and then which are the great options that you should actually implement, and which of the ones, well, that's a good idea, just doesn't make sense for your situation. That's the job of your CFP, doing comprehensive financial planning. And then it also tees you up for the third question, and that is, what changes are taking place in your tax situation for this upcoming year, and therefore what adjustments should you make right now in your tax funding, your tax planning to account for these changes? That is another question you've got to work with your CFP on for tax planning. If you don't have a CFP on your team, you can always contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.